Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host, and it is late Friday night, technically early Saturday morning, January 31st, and I want to start off by saying that I apologize for uploading a video a couple of weeks ago um, where the audio somehow didn't come through. I didn't even check it, I just assumed it was there. So I apologize for that. What I talked about in that week's video was specifically something that happened in the markets, in the global markets, with the Swiss franc. And let me go ahead and pull the Swiss franc. No, that's the Swiss franc US dollar, but let me pull up the Euro Swiss franc, because those are the two countries that it most impacted, it impacted a lot of countries worldwide, but it was mostly involved with these two countries. So you can see, so the Swiss government, their ECB type, central bank, Swiss central bank, I guess is what it's called, had a policy of what's called pegging their currency to the euro. So you can see that starting, you can see here it was moving, right? There was fluctuation between the euro and the Swiss franc, and then it kind of settled out. And along about here, you can see it more or less flatlined. This was because the Swiss franc was pegged to the euro. So what does that mean? Well, what that means is, as the euro would fluctuate, the Swiss National Bank would buy or sell euros in order to bring the Swiss franc into parity with the euro. In other words, 1 Swiss franc would equal 1 euro. That's what this non sloping price action is here from about September 2011 to just the week before last, or 3 weeks ago. And so what happened here, because the euro has been going down, so let's pull up the euro US dollar. So notice the notice the Swiss franc euro relationship. Let me pull it back. During this time was basically parity. Okay, there's not much difference here. This is the Swiss National Bank adjusting to fluctuations in the euro. Now, here's the problem. Here's what the euro has been doing. Since, what is this? This is March of 2014. It's just been going down. So what's happening during this time? And this may be, again, too much inside baseball, but this could prove to be a very important situation in world markets, and I want to point it out because it's a source of risk, and I'll talk a little bit more about why that's a source of risk. But so during this whole time, the the euro is going down, what's happening is the Swiss franc, they're having to print up more Swiss francs to buy euros, which in effect what they're doing, what the Swiss National Bank was doing, was importing inflation, the euro inflation, into the Swiss economy. And so the euro was going down so rapidly, they finally had to give up on this policy. They were spending money that they really didn't have to buy euros that were falling in value every day. It'd be like if a stock that you were interested in was going down, and every day you're buying more and more and more of it, and it's getting closer and closer, to zero. Let's say it started at 100 and it started going down, and you bought more and you bought more and you bought more, and you bought it all the way down to $30, and finally you said to yourself, I can't buy this anymore. I'm losing money. Well, that's effectively what the Swiss government did. And there's of course, it's just speculation at this point, but there's quite a bit of speculation that the that the Chinese will eventually give up on the dollar. They're doing the very much the same thing. Excuse me. When the dollar, of course, the dollar is going up right now. We'll pull up the dollar here in a little while, but if the dollar starts to go down for whatever reason, in a euro type fashion like this, the Chinese could remove their peg to the dollar and decide to no longer import our inflation into their economy. And this is where a lot of this money printing, people wonder, why is there no inflation? And there's a lot of speculation about it, but there's mainly because we're able to export our inflation to other countries. The secondary reason is that there are pretty powerful deflationary forces at work as well. So you couple those two things together, and you've got, even though we printed $4.5 trillion and put it in the economy, there's no inflation. So that doesn't mean there won't be inflation at some point. It just means it's not there now. Anyway, I felt like this was a very important occurrence in world markets, and it could have some ripple effects down the road if it hadn't already. I mean, we don't know, but this is a source. Central bank money printing and the way central banks interact with one another is a huge risk in global markets, and this is something that it's okay until it isn't. It's one of those type deals. So you're rocking along, putting money in your 401k, your IRA, or whatever, thinking the world's just fine, and boom, all of a sudden China decides to remove their peg to the dollar, and you lose half, the value of your 401k. And this is a very real risk, and this is something very, almost nobody understands about investing. You go ask your broker about this, you go ask your advisor, and they're right in some sense that you don't know. Nobody could predict it. And I'm going to show you a chart here in a second where this company wishes they could have predicted it, but you've got to figure out a way to work around it, because it's a very real risk in the marketplace, and it will wipe you out if you're there and you're on the wrong side of that trade. So I mentioned there was a company who wished they hadn't been a part of it, and I'll tell you a little bit. This company is called FXCM. It's the world's largest forex. I guess you could call them a broker. They operate an exchange, really, a forex exchange. And I read somewhere or heard somewhere, you can see their stock went from, it's pretty steady here, around $17. And let me zoom in. Let me show you like a 60-day chart, or actually I could show you even a shorter term chart than that. I want to show you how fast this moved. Let's look at a 20-day chart, because that was within the last 20 days, I think. Yeah, so you can see here, there's no price action between this point and this point. It just gapped, and there you were. And this move, I read somewhere that this move, first of all, it's almost bankrupted the company. The company may still end up being bankrupt. They were able to put some last minute financing together, but I heard somewhere that this was caused by about 75 customers. So these guys have millions and millions of customers, but 75 customers they were on the wrong side of this trade, and not only did they get wiped out, but they wiped out the exchange in the process. They wiped out about $300 million in cash. Just overnight, this company lost $300 million in cash. and my guess is they didn't have $300 million to lose. So you just got to know that when the money is really not based on anything, anything is possible. Anything. A central banker somewhere, in a place you don't even think about on a daily basis, can decide to do this or that, and boom, the dollar reacts. Your 401k reacts. I mean, it's just it's a mess. This global money system we have, but it's what we have, and I realize that all of you guys and I'm invested in it. But this is one of the reasons that I wanted to do this weekly program. Is I really wanted to get. I don't want to scare people, but I want you to understand the types of risks that are out there and how important it is to really follow closely what's going on. And when the selling looks like it's going to pick up, we just need to step off the track and let the train go by. Let it sort itself out, and then step back on the track when things are a little bit more calm. So that's one of the reasons that I wanted to do this program. I have a passion for these markets, but I also understand that the average person really has no idea what's going on in these markets, and you're never going to find out by watching CNBC or anything like that. So anyway, that's enough of that. But that's what that program was a couple of weeks ago, where there was no volume, and I apologize again for uploading that with no volume. I will, in the future, I will check the audio and the video before I upload it. Sometimes when I'm doing it late at night like this, I just go to YouTube, upload it real quick, and because it does take a while to upload the video. So anyway, let's go back to kind of the normal things we've been looking at. This is the interest rate market, and you can see here's that low we've been focused on, so I'm going to include that here. And then here's our levels of support. I'm going to zoom in a little bit on that. All right. Whoops. Oh boy. Okay. Sorry about that. Let me see if I can. There, I got rid of that. Okay, so here's our levels of support. This one was the one that I really thought would hold because it had such a long tail. Of course, it went up. Didn't even really test the old highs, rolled over, and really rolled over pretty strong. So we've been through this level of support. We've kind of broke it here, but definitely broke it here, and now have traded below it, below this low here. So the low I'm looking at is this low right there, this low right here. So we've traded below that low, and so what this means is that we're going to this area right here, somewhere in here. Oh my gosh, I'm having all kinds of trouble with my annotation tool. I'll have to maybe just quit using it. But we're going to this level here, and of course if this doesn't hold, then we're going to this decision point support area, which is off this low, which means we would have a new low. So that's the plan so far. Personally, I'm not happy about that. I don't want to see this low get taken out because I want to see this interest rate. Well, these interest rates are going up whether I want them to go up or not, okay? The question is, are they going to go up, are they going to hit this support and go up, or are they going to make a new low and then kind of hammer out a bottom and then go up? So, I don't know. Nobody knows, really. So, I'm just adding to the fact that I would be disappointed if this support level did not hold and we went down to this support level and made a new low. I've talked about it before, but interest rates kind of run in a 30-ish year cycle, and I think we're in year 34, so we're very overdue for a turn in interest rates to start going the other way. And of course, with all this central bank activity, I guess that's had some additional effect on the market, and we've gotten interest rates longer in this cycle than we typically do. Let's look at the volatility index. This we've talked about this before. This is so. Wait, let me go to the S&P 500 first. So if you notice for the week, as soon as it comes up, the S&P 500 was down for the week. It was down 1.3%. You can see right here, roughly 26 points. And so normally, if your market is down, then when you go to the VIX should be up for the week. And as you can see here, it was right here. This white bar here means the VIX was up for the week. The VIX was up almost 12%, which is a pretty good move, but we're still below this little channel that I have highlighted. And I think until you break out of this channel, you really have to consider that this market is probably going to make a new high. Breaking out of this channel, and we broke out of it a little bit today, but really, I mean, look at where it turned around. That's pretty amazing. It never ceases to amaze me. You have these lines drawn on the chart, and the thing just goes right to it. Actually, you can see it kind of went through it a little bit more and then came back. So anyway, until it breaks it convincingly, I think you have to assume that we're going to make a new high. The other thing, let me show you on a 60-day chart, or this is a 1 hour. Okay, so each bar here is 1 hour. But I want to show you something that I've just seen time and time again. It gets old, actually, just seeing how often this happens. But if you notice right here, between this bar and this bar right here, and I'll zoom in a second, but I'm just going to put a little box there. There's a gap there, and there's another one right back here. In these gaps, let me zoom in on it just a little bit, and let's look at it. These gaps, there I go again with my tool. These gaps get filled, okay? Anytime you have a gap like this, the market, comes back and fills those gaps. Now, this could be the one time that the gap doesn't get filled and the market sells off for the next 18 months, and this gap doesn't get filled for, say, 4 or 5 years, 6 years. But time and time again, I've seen the market gap down like this, go down, look like everything is going to just, blow up, and then you get a big rally. Janet Yellen says something, Ben Bernanke says something, you get a big rally, the gap gets closed. So just keep that in mind. We have these two gaps. We have this gap here around 2056 or whatever that is, and then we've got this other gap right here, which to close it we'd have to get to about 2091. So if we get to 2091 to close this gap, we're going to make new highs. Okay, we're going to come out of this channel and make new highs. Now, we might just make a slightly new high, right? Maybe we don't get all the way to the top of the channel. Maybe we just take out this high and roll over. The market looks very, just in general, it looks very, very tired, like it wants to correct. Basically since, what is this? This is September of last year. We really haven't done much. I mean, the market is up for the year, but I mean, almost. Well, I say it is. Maybe it's not. Let's the year marker is right here. So this is where the market closed for the year. The S&P 500 closed at 2019, and we're at 1994. So we're actually down for the year at this point. But in another couple of days, I mean, we could be up for the year. So we're in a place where the market's just trading sideways and not really doing a whole lot. So, when it does that, um, there's not much to do really until it starts picking a direction. But to me, this kind of looks this whole, some people could call this a head and shoulders. A head and shoulders, it has to break. One of the reasons I have that line there is this is called the neckline. So this would have to break, and the idea is if you measure from the top of the head to the neckline, so whatever this distance is, what is that, 1975 to 2100. So 100 points or 200 points. So if this were to break out, it could go down this way. And that pattern's a pretty reliable pattern, but it's not very well formed here. So that's why I'm not focused on it too heavily. And you probably shouldn't either. Let's look at the UK. We had this trend line on the UK. Oops. Yeah, let me get back to a weekly. We had this trend line on the UK, and it fell out of that pattern. Found support off of, I guess we did that off of this low. So it found support off this low. Looks like it wants to retest that. And it might, I don't know if you can see this red and blue line here. They're starting to curl down. This blue line is a 30 period moving average, and the red line is a 50 period moving average. So this would be 30 weeks and 50 weeks. Well, you can see that the blue line, which is the faster line, has crossed through the red line. Let me zoom in on that just a little bit so we can see. You can see they crossed right here. So a lot of times what will happen, market will fall through these lines, they cross, and then you get some sort of retest. Back up to these lines or thereabouts. This is called a Bollinger Band. I think I've talked about this before. Inside these bands at any one time is something like 98% of the price action. So you have a 98% probability that the price action is going to fall within these two bands. You can see that sometimes it comes out of the bands, but most of the time the price action is in the bands. Anyway, so you might see it get up to here and then maybe roll over, or and this looks like a pretty strong move. We might see it come up and retest these highs. We'll see what happens. But to me, the UK looks a little weaker than. Well, I don't know. It looks about as weak as the U.S. market, I guess. Germany looks a little stronger. It's bouncing, and that makes a lot of sense. You got all those problems over there in Greece, and this new guy was elected, and he's clearly like I don't want to say socialist. We throw that term around too much, but he's definitely a populist. He's basically gone out and said, yeah, I'm against the bankers. We need to ignore the bankers, and we don't need to worry about these debts and paying them back and all that stuff. We need to make sure people have jobs. And, the reality is they've borrowed a lot of money. These people had loaned them the money, expect to get it paid back and paid back with interest. And this guy's just kind of thumbing his nose at them. So, Germany looks really strong, but Germany's kind of, tied at the hip with these other people. And it seems like the further south you go in Europe, Spain, Italy, Greece, and I love these countries. I've been to them. They're great countries. But it just seems like the further you go, the worse the financial situation is. And the further north you go, the better the financial situation is. So don't buy any, Greek bonds, or don't buy any Spanish stocks or Italian stocks. I just think, that's probably not a good place to be. right now. You want to buy some German stuff, that's good. You want to buy the EWG, which is Germany. It'd be like buying our S&P 500. And then Japan's been in a trading range for a while. It's still in the trading range. There's not much going on there. Right in the middle of the range at this point. So really nothing to say about Japan. You know, the pattern, the trend was up before it got into this range. So we were trending up. So chances are this is a consolidation and it'll break out to the upside. But until it actually breaks out above this line at 12.18, 12.18, there's nothing to do here unless you want to sell, you know, some call spreads or something under, some call spreads above it or some put spreads below it if you know how to do that. If you looked at interest rates, let's look at the global Dow. The global Dow, to me, it looks a lot like the UK. We've got kind of a break of, same kind of deal here, except the lines have not crossed yet. You can see here they're still kind of sitting on top of each other, but you got this move down, back up, move through both of these moving averages. See how this retest, see how it went right up here and rolled over, and it made a lower high and then made a lower low, and then see here how this is creating resistance right here, and this will continue to roll over especially if the price action, even if the price action comes down here and bounces again, you'll see this go up and down and up and down until it really goes like that. That's kind of how they do that. So, this is, I suspect this support is not going to hold. I suspect you're going to see something like that, but the support could hold, and then if you got up above, above this high right here, you could say that, well, these guys are, turning it around, the global Dow. So, and again, the U.S. market is about 40% of this, so a lot of this depends on how the U.S. market looks going forward. I mean, if the U.S. market doesn't look good, this chart is not going to look good. Let's look at the dollar real quick. I've got a picture of the dollar here. You can see that starting in 2002, which is some of you don't know, but this is the exact time the bull market started in gold. And what you'll notice is that basically, this is just an inverted looking chart of the gold chart. And the reason I have this channel drawn on here, so a lot of times if you take the low and the next high and you take those two points and you extrapolate them with the next new low, if there's a couple things that could happen that we look for, but you can see this top channel line. If the dollar breaks out of this channel line aggressively, then the dollar's going much higher. I mean, even if it breaks out like to here, okay, and pulls back a little bit, if the dollar breaks out of this channel, then it's going much, much higher over the next several years. If it kind of hits this channel and pulls back and then goes through, it's going much, much higher. If it hits this channel and goes down, then this channel will likely hold for the dollar. In other words, you'll see the price action bounce around in this channel. But at any time when it breaks out to the upside, you're going to see an acceleration in the dollar, which means gold would go down. So if this is going up, that means in general, there's exceptions to that, but in general, if this is going up rapidly, it means gold is going down, silver's going down, oil's going down. Anything that you buy in US dollars is going down in the way of commodities, okay? So since we brought up gold, let's look at gold. Gold is, more and more people are talking about gold. Seems like So here's where the gold, the bull market started in gold. It actually looks like it started in '99. So just, I guess it started its move ahead of the dollar. But here's kind of where the high, here's where the high was in gold, and then we've had this sell off, pretty brutal sell. I mean, people don't realize, you know, gold is down like 40%, you know, off its highs. So that's pretty. Now it's not anymore because it's had a rally, but and that's what I want to talk about now is the rally. Kind of got this little channel, this little barrier channel drawn in here, and you can see that it held, you know, every time here. It held here, it held all through here, it held here, it held here, and then look how we've broken out of it, and we've almost come back and just retest the top of this channel. I think this is a pretty good place, and maybe you get another test. Sometimes you get one test, then you get a second test. But if you know, either you could buy here and buy gold here and play for it to go up, or if you buy here and it goes back down below this channel, then you might want to sell. But I think this is a good place, or you could see it retest the channel again. I think that's likely to happen. I think you could see gold continue this move back. It might bounce a little bit and then pull back again, but test the top of this channel. I think that's a good place to enter gold if you're interested in gold. Or you could enter right here. I mean, this is an okay place too. You just have to be willing to let it go back, you know, all the way back into this area before you say you're wrong. So sometimes it's better just to wait and let it come on back to that area and then enter. But you can see gold. Gold looks like, for the time being, it looks like it's going to make some moves upward. I don't see it moving much above, you know, $1,500, but anything's possible, like we said earlier. So I think that's about it. I don't think there's anything more really to talk about at this point. Of course, you know, there's a lot in the news. The Fed's really not saying anything different. I don't expect they'll start to say anything different unless our market rolls over in a pretty big way, which is certainly possible. But right now, this channel seems to be holding, and as long as this channel holds, you know, then we've got a pretty good chance for making new highs up here like this, around 2100. So that's it. If anybody has any questions or wants me to talk about something in particular, something in the news I don't understand. The other thing I thought we might do is I want to show you two charts. This is the S&P 500, the S&P index, and then another chart is the SPY. So I was actually talking with my mom about this the other day. And if you notice, these charts look identical. I could lay them on top of each other, but trust me, the SPY and the S&P 500 look identical. And you know, one of the things you can do in a brokerage account, instead of buying mutual funds and things of that nature, you can just buy the SPY. And it's the same thing as indexing. And basically, as the S&P 500 goes up, your money goes up. If the S&P 500 goes down, your money goes down. And if you notice today, the SPY was up 1.26. If we go back to the S&P, or it was down, 1.26. If we go back to the S&P 500 index, which I didn't click on the right thing, you'll notice it was down 1.3. So they're correlated almost 100%. There's slight differences because of the expenses and whatnot that they have to use to mirror this index. They have to use futures, and sometimes when they roll from one contract to another, there's some losses there that they have to incorporate in the fund. But for the most part, these things mirror each other 100%. So this is something maybe we might do here in the YouTube, just to just to give everybody a feel for it. I might go out there and buy, 300 or 400 shares of the SPY, and let's just see how that goes. And we can go here to the monitor tab, and we can look at if we had some. We don't have any positions here, but if we had some positions here, we could follow their how well or how poorly it's doing. And then we might even do some more sophisticated things just to expose you guys out there to different ways of making money in these markets. So that's it for this week, guys. Just if you would, just promote the channel to your friends, family members. Especially if things get dicey, they're gonna want a place to go where they can, get some information about what the heck's going on in their accounts and what's going on in the markets and what should they do and so on and so forth. We've talked about some of the psychology, and that's really what I want to help people with: the psychology and the risk, understanding the risk in these markets. So until next week, guys, thanks a lot for coming in. We'll see you then. Bye-bye.